One big misconception is that tax loss harvesting eliminates taxes altogether. In reality, it only defers them. While you can use losses to offset gains now, eventually, when you sell the investment you bought with the tax loss proceeds, you'll likely incur a gain that will be taxed. Essentially, you're delaying taxes and not avoiding them forever.
Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride.
Welcome to Critical Thinking Required, where we break down complex financial topics to help you grow and protect your wealth. I'm your host, Nathaniel, and today we're diving into a strategy that we get asked a lot during this time of year, tax loss harvesting. So let's start with the basics. What exactly is tax loss harvesting? Tax loss harvesting is a strategy used by investors to offset capital gains by selling investments in taxable accounts at a loss. Here's how it works. If you sell an investment for less than what you paid for it, you can use that loss to reduce the taxes you owe on gains from other investments. And if your losses are greater than your gains for the year, you can even use up to $3,000 of those losses to reduce your ordinary income taxes. Now, there are definitely some nuances and rules to it, which we'll touch on later. Let's use a $500,000 portfolio to walk through an example. Let's say you bought $100,000 worth of Netflix stock. Netflix releases their quarterly report, and let's say Wall Street is very happy with all the numbers. So the stock's price goes up. Now, your Netflix stock is worth $130,000. You happen to need some cash for a house down payment, so you decide to sell the stock, taking the $30,000 gain. Now you need to pay taxes on those gains. You notice that another of your holdings, let's say Peloton as an example, is not doing so great. You're down almost $50,000 from when you bought it. So this is perfect because you can then sell the Peloton stock to offset the Netflix gains. So the pros, as you can see, the pros are pretty clear. Number one, tax savings. The most obvious benefit here is the potential for tax savings. By harvesting losses, you can lower your taxable income. Number two, offset ordinary income. If your losses exceed your gains, you can use up to $3,000 of those losses per year to reduce your ordinary taxable income. That's a nice bonus because it helps lower the taxes you pay on your salary and other sources of income. Any additional losses can be carried forward to future years. Now for the cons. Now, like with any other strategy, tax loss harvesting comes with its own set of downsides and common misconceptions. Let's take a look at those. Number one, it doesn't eliminate taxes, it defers them. One big misconception is that tax loss harvesting eliminates taxes altogether. In reality, it only defers them. While you can use losses to offset gains now, eventually, when you sell the investment you bought with the tax loss proceeds, you'll likely incur a gain that will be taxed. Essentially, you're delaying taxes and not avoiding them forever. Number two, watch out for the wash sale rule. The IRS has something called the wash sale rule to prevent people from taking advantage of tax loss harvesting too easily. This rule states that if you sell an investment at a loss and then buy the same or a substantially identical investment within 30 days, the loss won't count for tax purposes. In our example above, if you sold the Peloton stock at a loss, but then bought it back 2 weeks later, you wouldn't be able to claim the $30,000 loss on your taxes. Number three, are you thinking long term? One of our biggest issues with people asking for tax loss harvesting is this. What's your investment time frame? Is saving $2,000 in taxes right now worth a lower, longer-term return. For example, if your portfolio performed really well this year and you have some gains, and yet you only have one investment that is currently down but still has great potential, would you want to sell it and risk losing a potential much greater long-term return just to save a couple of $1,000s today? So, is tax loss harvesting right for you? It depends on your personal financial situation. If you have a taxable account and expect to have capital gains, harvesting losses can be a useful way to reduce your tax bill. However, do you need to reduce taxes just because you think this is the right thing to do? Or do you maybe not have the cash flow to pay the tax from a sale? Thinking about the complexity of the strategy, the potential for deferred taxes, and the wash sale rule are all things to consider. And that wraps up today's episode on tax loss harvesting. If you found this helpful, be sure to subscribe and share this podcast with others who want to learn more about managing their wealth. As always, consult with a financial advisor or tax professional to see if this strategy fits your unique situation. Thanks for tuning in to Critical Thinking Required, and we'll see you next time.
Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time,